Here's the problem. Saving more money for your own retirement with tax-deductible corporate earnings, but without including your employees. You might want to include some of your management team, but you can't afford to include everyone on your payroll. Because the money you can contribute to a company 401k plan for yourself or your management team is strictly limited by how much goes into your average employee's account, which is typically much less than you want or need for your own retirement. What's worse is all the regulatory compliance, reporting, and limitations, in addition to the non-discrimination requirements of a company pension plan that prevent you from using tax-deductible corporate earnings to fund your own retirement. So what's the solution? Section 162 and Section 7702 of the Tax Code. Section 162 allows any business to deduct bonus compensation paid to any employee, including a corporate owner, on a selective and discriminatory basis. And Section 7702 allows the bonus money to accumulate and earn interest without any taxation and without any investment risk. But it also allows you to withdraw income during retirement without taxation and without any risk of losing your money. What's more, there are no limitations or restrictions on the amount of money you can put into the plan. This combination of tax code provisions and contractual guarantees is known as an executive bonus retirement plan. An executive bonus retirement plan is entirely selective and discriminatory. It's also easy to set up and easy to change, too, because there is no IRS approval required, no ERISA compliance or reporting, no administrative fees or management expenses, and no investment risk to either the business or the executive. Because your money is contractually guaranteed to earn interest, based only on the gains of an equity market index, like the S&P 500, the NASDAQ, or the Dow Jones Industrials, net of any commissions, fees, or expenses, and without any risk of losing money in the stock market, because all of the money is accumulated within cash value insurance contracts that qualify for tax-free growth and tax-free withdrawals under the tax code. Here's how it works. As the corporate business owner, you choose who to include. You determine the bonus amounts, and you control the funding. You can even increase the bonus in good years or decrease the bonus in bad years. But as the executive, you own the contract and control the withdrawal of tax-free income when you're ready to retire. The business pays the tax-deductible bonus directly into the contract annually or quarterly, and that bonus money is taxable to the executive. But 100% of the growth on that money and 100% of the money withdrawn during retirement can all be tax-free, which means that you only pay tax on the money going in, but not on the money coming out, which can be 2 or even 3 times as much. For example, Charlene owns a very successful restaurant in Kansas City, and since 2004, Charlene has been giving herself a $20,000 annual bonus, which the corporation pays directly into her personal executive bonus retirement plan. Charlene intends to keep funding her plan with the same amount every year, so that by age 66, she will have transferred $400,000 from her business into her own personal retirement plan. Her plan is guaranteed not to lose any money, but is projected to earn another $400,000 by the time she's ready to retire, based on the growth of the S&P 500 stock index, and assuming her projected accumulations. She plans to withdraw $4,000 each month, tax-free, for 20 years, receiving at least $960,000 of tax-free income. So ask yourself this. Does it make sense to accept all the restrictions and limitations of a company 401k retirement plan? Restrictions and limitations that prevent you from using your own corporate earnings to save and invest enough for your own retirement? Doesn't it make better sense to use tax-deductible corporate earnings to fund your own retirement savings with tax-free growth? and tax-free withdrawals, but without including all of your employees, without any regulatory compliance or reporting, and without any investment risk or administrative fees?